Hello, everybody. It's Matt Canis here from Intuit Canada. I want to welcome all of you, whether it's good morning, good afternoon, or good evening. We are live from Toronto and want to welcome folks from Australia to the United States, South Africa to Ghana on this awesome webinar that QuickBooks Canada has partnered with HubDoc and Practice Ignition to basically help you scale your business through building and implementing a fixed fee pricing plan. So before we get started, I'm going to pass it over to my esteemed partner, Yusuf West, who will just give you a little bit of the overhead on the logistics of the call and what you can expect.
Hi, folks. This is Yusuf West from HubDoc. Super excited to be here. So as you know, today we'll be talking about the secret to scaling, how to build and implement a fixed fee pricing plan. I'm joined here by not only Matt, but also Tom from Practice Ignition. Tom, do you want to give a quick introduction on yourself, and then I'll do mine?
Yeah, hi everyone. I'm really excited to be here with both QuickBooks and HubDoc. Really looking forward to presenting this content to you today. We really hope you take away a lot, and we hope you ask lots of questions.
Cool. Hi, folks. This is Yusuf again. So I lead marketing over at HubDoc, and just before we get into the nitty-gritty, get into the content, just want to cover off a couple logistical items. So first of all, this is being recorded, so you will have access to a recording of the webinar. The slides will also be shared after the webinar, and you can expect a follow-up NPS survey a couple days after this, because we'd love to hear your feedback. And just to share a little bit of the genesis behind what we're doing here, we've heard a lot of feedback about people being excited about the cloud and getting that that's the future, but also wanting more of the tactical playbook. And so this is, a joint effort on all of our sides to bring you that tactical playbook and give you takeaways that you can implement in your practice today and next week and next month. So super excited to jump in. Just to make sure we're all here and engaged and awake. I know it's 7 p.m. here in Toronto. First, love to get a sense for your practice and understand what scale you're operating at. That just helps us tailor the content a little bit better. So the poll question is, how many monthly bookkeeping clients are you currently serving? 1 to 9, 10 to 30, 31 to 99, 100 plus, or perhaps none. Maybe you're just getting started, or you have a tax practice. Wow, we're getting great engagement. So seeing about 78% of people that have voted, 80% already. Let's see if we can just notch that up to 90%, and then we'll share the results. All right, 3 more seconds. 3, 2, 1, and 90%. That's awesome. So let's share the results. Okay, that's awesome. That's really great. So what we're seeing is that 47% of you have between 1 to 9 monthly bookkeeping clients. 37% are in the 10 to 30 bracket. 11% are at the 31 to 99. 2% are scaling past 100, and 3% perhaps are just getting started or primarily have a tax practice. So really great, and thank you so much for engaging with the poll.
All right, so Tom here again. So I'd like to just walk you through what we're really going to cover across today. So one of the first things we're going to cover through is the introducing the cloud accounting or bookkeeping business model. Really important to set those the context of what we're doing here today. Then we're going to dive into the meat of this webinar and how we're actually going to bundle services so that we can price up in a fixed fee way. And of course, in doing so, we need to determine our baselines using a time cost method. And then we're going to move into some of the afterthoughts of what we need to do in order to have the value conversation with our clients, particularly your existing clients. And then what this means in terms of scalability, how you can increase your profitability using a fixed fee billing model. So The inspiration behind this webinar actually comes from a famous accounting practice, or semi-famous, I don't know, interactive accounting out of Australia. It's actually our CEO's practice. So Guy Pearson, if you're familiar with Practice Ignition at all, he is the founder of both Interactive and PI. Now, interactive accounting had the advantage of being 100% cloud from day one. So they were able to implement and systematize their processes very, very quickly. Now, they adopted a fixed fee billing model because they studied startup software companies. Now, why would they look at software startups, particularly software as a service? It's because they have a repeatable business model. In other words, they're in a position to deliver value or deliver their services on a monthly basis in a very efficient manner. And it's typically done so by leveraging technology and processes to automate and streamline the delivery of the value to the customer. Also, SaaS companies, software companies, just like Practice Ignition, QuickBooks, HubDoc, for the most part, they bill on a monthly basis. And therefore, companies like us actually have to win your business each and every single month. Now, with the cloud accounting and bookkeeping model, there's actually very little difference between the two. All right. So let's dive into what is the accounting and bookkeeping business model. So I think it's safe to say you've probably heard your fair share of content around why we need to move to a fixed fee model and why pro advisors need to adopt cloud technologies. This is certainly not going to be the key takeaway from today's webinar, but it is important we start with the fundamentals of what a traditional model looks like. Let's break down its key components and then rearrange them to introduce a fixed fee cloud business model. What I'd also like to show you is, or what I'm about to show you will provide some context around why we recommend a fixed pricing structure and how it actually works to build a scalable business model. And it's important to remember that when we're talking about scaling your practice, we're actually talking about building the most efficient firm you can. So it doesn't actually have to result in monster growth. It just needs to be as easy as possible to bring on your next client. Okay, so there are three components you can see on your screen that are certainly not exclusive to accounting or bookkeeping. In fact, these are actually the three components any business model, for that matter, needs to address. But for the purpose of today's webinar, of course, we're going to focus on how these components work in a fixed fee accounting practice that has adopted cloud technologies to deliver their services. So when we get to the pricing side of today's content, I really want you to think about or keep these three components at the top of mind when we talk about it. So the first thing we need to consider is that your cost structure and invoicing need to line up. In other words, you need to be able to receive payment as the cost for the delivery of your services fall due. So some examples of costs, as we can see, staff wages, rent, internet, your software subscriptions, etc. They're all falling monthly. We need to be able to ensure that we're not carrying those costs on behalf of our clients. Now, in order to align your cost structure and receiving payments as they fall due, you need to generate value for the client as you're delivering that invoice and requesting payment.
Well, so Tom, I just had a question about these key components. Out of the value, costs, and invoicing/payments, what is the component that advisors typically underestimate?
Yeah, so I would say that of the three, I think the invoicing and payments is typically underestimated, particularly the frequency and how you're going about collecting the payments. It's really important that we keep that in mind, and we're going to sort of tackle this in the next few slides here as well. Okay, awesome, that's good. Cool. So let's have a look at what the traditional accounting model looks like. And in this example, what we're looking at is the typical sort of delivery of a compliance service. And this, in the context of what you're seeing on your screen, this is one single client. So as we can see, there's always inevitably a misalignment between these three components. The cost bar that you can see on your screen right now represents staff and time costs, and inevitably it has to be carried until the value is delivered. Now, in a compliance business model, value is typically delivered only once a year and is typically measured in time spent delivering that compliance. And the fee varied based on the staff member completing the work. Now, in this model, of course, invoicing can only ever be done in arrears because time had to be calculated to generate an amount to charge your client. So one of the problems that you can see with this model is that invoicing happens long after the client accepted your services. So perhaps they, signed on with an engagement letter in January, and as we can see in this particular example, we're not actually performing the duties until August. So it's a real sort of a big gap between them agreeing to becoming a customer of yours to you actually performing the work. What we also see as a problem here in terms of invoicing is that it's very common for practices to wait a week, up to 2 weeks, maybe even up to a month before you actually deliver the invoice to the client after the value is delivered, and that could be for any number of reasons. Now, the problem with this is that for every day that there's a delay between delivering value and requesting payment, your client's perception of the value they receive decreases exponentially. So what this has resulted in is typically 50 to 60 debtor days being considered a good benchmark, and we really need to get away from that. So I think the biggest takeaway that we can see from this slide is that it's clearly not scalable.
Yeah, and Tom, looking at the slide, like you can see where all the costs are, you can see where all the value is, and really payments are right at the end of it. And so when you think about the risks you're taking as an accountant or bookkeeper, there's kind of a misalignment between risk and reward.
Yeah, absolutely. I mean, as you can see, we're putting in a lot amount of costs up front, and you're really risking not being paid at all. And obviously that's happened to many, many people, and we really want to start avoiding that.
Right. And one of the other questions I had, let's say I'm a bookkeeper and accountant with 10 clients. Like, what does scalability mean to me? Like, how does that relate to my practice?
Yeah, absolutely. So, I mean, it goes back to what I was saying before about scalability, not just meaning, massive growth. It actually just means your ability to take on more work in the most efficient way. When time is the only method by which value can be delivered, the only way to bring on a new client without impacting other client work is to hire more staff, or to have that have the ability to actually deliver that value. Or the only other option is to work more hours in the day. So really what we have is a small ceiling in terms of the number of clients you can service well. And these were really the only two ways that you can raise that ceiling. So it goes back to that idea that we want to be focusing on efficiency, and that's what we're talking about in scale.
Awesome.
Cool. So for the bookkeepers that are out there, I wanted to not just talk about compliance services. Let's actually have a look at what the traditional model of bookkeeping looked like. So what we still see is value is still in the form of time, would actually be delivered slightly more frequently. So we can see that we're closing the books more regularly, maybe every month, maybe every couple of months, whatever the case might be. Now, in this context, the costs are still staff and their time spent on delivering the service or delivering other clients' work as well. And of course, invoicing is still in arrears, but we see a clear issue coming up, as we can see on the slide. You might start working on the next month's books before you actually get paid for your previous month's work. Now, that's only sustainable for so long. So perhaps you get to a point where there's your cash flow has been impacted. So for this particular client that we're looking at, you might stop work until you actually get paid. And at this point, the client experience isn't great, but that's their fault. But they're not going to see it that way. It's actually, it's just not a good scenario to be in. It's quite toxic. And the next problem is that when your client finally does pay, you now have a large amount of work that you need to catch up on while still delivering value on time for your other clients. And that's how we get into these 14-hour days. And of course, we still have our debtor days that are coming up as well. And beyond that, there's actually a tremendous lost opportunity because of the fact that the data is being uploaded and downloaded intermittently. And your client can only ever see these numbers once the work is fully complete instead of real time. And so obviously this is not an ideal scenario. And we can also see that this model is not scalable in the context of efficiency. So what we're looking at on the screen right now is what happens when you start to adopt cloud technology, but you retain an hourly billing model. And this is, again, probably more aligned with that sort of compliance example that I provided earlier. Your costs to deliver a specific service are now coming in monthly. So think about all your software subscriptions. They're typically billed on a monthly basis. Internet, phone bills, the list goes on. So now if you're still only delivering value once or twice throughout the financial year, you're carrying these costs. Now, this is probably okay for a couple of clients, but this is not sustainable over a much larger number of clients, even if it's 10. The problem with retaining hourly billing as your core billing model is that apps get rid of the uploading and downloading of data. Cloud apps talk to each other, like for example, HubDoc fetches a document and then it attaches it to the correct journal entry in QBO. So what this actually means is you're spending less time to do the work you were doing before, and therefore your ability to earn has significantly decreased. So the other interesting notion to point out here is that, and I mentioned this in the last slide, we're experiencing a tremendous lost opportunity. Your client's QuickBooks Online file has the ability to deliver real-time data, but if you're still only working on their file once a year, then you lose that ability to become a fully trusted advisor. Your value proposition isn't quite as good as it can be, and that's exactly where cloud software comes in. Again, in this case, we're still seeing that we have a problem of billing in arrears and it not being aligned with the actual value delivery. So, what does this look like in a true cloud business model? And how do we see these three components now aligning? So, of course, costs continue to be due monthly, so we need to start avoid carrying these costs year round, and we need to start delivering value on a monthly basis and, of course, throughout the month. Cloud apps, they do provide you with the ability to do this really, really easily. Part of the value proposition here is that the real-time financials that you can actually deliver, which allows your clients to make better decisions a whole lot faster. So to avoid carrying these costs, we need to invoice on a monthly basis as well as get paid on a monthly basis as the core of your billing model. Of course, there's going to be different scenarios of one-off fees and things like that, but the core, let's think about the main things that you do. So the easiest way to do this is to add on additional value in the form of a monthly deliverable, such as maybe a debtor report, cash flow, or P&L that you can comfortably deliver as you invoice, and therefore you should start to expect payment on time because you're delivering value at the same time.
And so, Tom, when we talk about real-time financials, how does that deliver value for the clients of advisors? What value do real-time financials deliver for small businesses?
Yeah, for sure. So, I mean, most small businesses, when they don't actually have real-time access to financials, they're making business decisions on basically their bank account. So really not a great place to make some big decisions. They don't have the visibility in their business and what's actually really happening. And so, getting into a position where we can deliver real-time financials creates a massive opportunity for pro advisors to increase their visibility for their client and provide forward-looking advice more regularly. This should definitely result in better decision making by the small business owner and a whole lot faster as well.
That makes sense.
Awesome. All right. So we're going to finish off on this. I promise that we're not going to keep talking about why and how this. We're going to get into the how very shortly, but to finish off, what is it that fixed fee billing provides? For your clients, it's definitely going to be a result of a better service for the same costs. They're also going to be much more confident in you as the trusted advisor because you're delivering their recurring services at a much higher standard by leveraging the technology and delivering above and beyond what they used to, particularly from their previous accountant and bookkeeper who might be still stuck on desktop and old processes and billing by the hour. For you, what we really should expect is to deliver a more efficient service that should result in, it definitely will result in higher profits, provided you execute correctly, of course. Now, what this also means is more opportunities for value-priced projects, and I'm going to get into that a little bit later. But what is really cool is that you're no longer going to be concerned with time for billing, and you're really going to focus on efficiencies rather than just pure time. Okay, so when we look at the cloud business model with fixed fees, let's go back full circle, and I'm going to provide you with some golden rules of these three components in the cloud business model. So, of course, the most important component of the three is the value delivery. In the scenario, as we've already seen, it's critical that value is delivered to the client on a monthly basis in order for all of this to work. So if it's something simple that you can deliver, such as a cash flow report, this is really going to help you align the value delivery with your invoicing and costs. Now, on the cost front, if you can align all of your costs on a monthly basis, it will help your business become more predictable. So good friend of Practice Ignition, and I'm sure HubDoc as well, Chris Hooper from a Codex Partners. If you haven't heard of a Codex, it's ACCODEX. They're an accounting practice very hell-bent on changing the way the industry runs, based in Australia in Adelaide. He came and talked to the PI team recently, and he told us that he actually pays all of his vendors on a monthly basis with the exception of maybe one or two. So even his Salesforce subscription, they send him an invoice quarterly, but he pays them monthly. And the reason why he does that is because it helps him predict his costs and his cash flow well into the future. Now, here's the big one. So on the payments front, the ideal scenario in a fixed fee billing model is to be paid upfront prior to your value delivery. What we get in a fixed fee scenario is an exchange of risk between you and your client. So you fix the prices of your service based on the information that's been provided to you by the client. So as such, you're risking a potential fee blowout if the scope of work has been misunderstood. So in exchange, you're risking not being paid for the services being rendered. You'll need to mitigate this risk by having your client enter in a pre-authorized payment agreement at the start of your relationship so you can collect payment automatically and it become a non-issue. Sometimes you're going to get some clients that are not really keen to do that. But it's at this point, it's explaining that exchange of risk and having a really mature business conversation, from business person to business person. That should be enough for them to understand why you have this process in place. And if someone is still not willing to go through with this, it's a really good indicator that they're not going to be an ideal client and they're going to be problematic into the future. So something very, very much that you should be considering here.
Okay, so we're going to go into our second poll now that we've talked about hourly billing, the cloud model, and how value, cost, and invoicing/payments fit into the cloud business model. We're going to kick off a poll to find out what pricing model you're using. Just helps give us a better sense for how you're operating today and ensure we're delivering value on this webinar today. All right, wow, people are chiming in really quickly. This is awesome. Just over 70% voted. Let's see if we can get it over 80. We're quickly getting there. Yep, just over 80%. And we'll give it another 5 seconds, see if we can get it to 90. 3, 2, 1. Almost there. That's good. So we're just going to share the results. So 32% of you do hourly or time cost billing. 20% are already on fixed fee, which is awesome.
Good to hear.
Yeah. 47% do a mix of both, which we often see as people are trying to transition to fixed fee. 13% are doing value pricing. It's super great. And then 2% aren't sure.
Okay, that's great.
Yeah.
So I think the cool thing about mix of both, that's great. We're starting to adopt a pricing model. What we might show you now will hopefully help you figure out ways to maybe move everything over to fixed fees. There's always going to be some services that require a unique scope of work where hourly billing might actually be the most effective model, but ultimately there's a lot of things you can do to move more of your services to fixed fees. So this is really cool to see. Thanks, everyone. Alrighty, so here's what you really came for, is how to bundle monthly service with packages into fixed fees. So we're going to dive into these fundamentals, and I'm going to premise this following content with this. There's so many valid and proven ways that you can approach pricing your services, value pricing being one of them. What we are about to present is simply just one option that you can use. So, if you decide that, this isn't really going to work for me, that's fine. We'd love to know why. We'd love to sort of understand that so we can, maybe help you out. But, this is the reason why we're actually presenting what we're about to present is twofold. Firstly, it's simple. Not much more to be said about that. Secondly, it's been proven. This is the exact process that Interactive Accounting took, and actually quite a few other fixed fee practices used to price their services, and the results have been truly extraordinary. However, it is important to remember that the success or failure, I don't want to stumble over that word too badly, the success or failure of this pricing approach lies in constantly reviewing your pricing and, of course, fantastic execution. So the very first step in this process is to look at your current clients and start forming cohorts. So you're probably wondering, what is a cohort? Very simply, it's a group whose members share one or more similar characteristics. So very simply, what makes your clients, what are the similarities between your clients? Alrighty, so how do we start a cohort analysis? The easiest place to start to dissect your client base is the frequency in which you currently serve them. So who are your monthly clients? Who are the clients you deliver services to on a quarterly basis, and of course on an annual basis? You might find you have more cohorts than that, such as, maybe you do something twice a year for a client, but if that's the case, then of course that will be a cohort for you. Alrighty, so now that you've broken down your clients by their frequency, the next step is to start looking at what services you actually provide them. And chances are you're going to see that you provide the same basic set of services to about 90% of each cohort. In other words, or for example, 90% of your quarterly clients receive tax lodgements, financial statements, and quarterly review meetings. So what we'll start to see is that these will become your core services. You'll then start to see that many of your clients in the same cohort have additional services that you offer. These services will become sort of additional add-on services that will make sense to offer outside of the core services of each cohort. You'll also want to pay attention to which software you use with each of your client cohorts. So this is a lot of information, but I'm going to show you an example right now. So let's say you split down your monthly, quarterly, and annual clients. And for our monthly clients, we've found out that, okay, for about 90% or whatever number you want to decide when you start to see a pattern, the core services for them are bookkeeping, ongoing support, answering questions about their books and things like that, also training, updating and delivering training manuals, and a monthly debtor report. This becomes your core package. These are the 4 services that absolutely every bookkeeping monthly client or every monthly client is now going to receive. Likewise for quarterly, maybe you do the bookkeeping as well, but just on a quarterly basis. Sales tax, quarterly reviews, support again, and again annual accounts. We can see, annual clients, we're doing annual accounts and tax returns. Now let's focus on quarterly for a moment. All of my clients, or maybe majority of the clients that I've now identified as my quarterly clients, all use QBO, or they all use HubDoc, and they all have some version of tax software that you're using to lodge their tax returns or tax lodgements. Now, if that's not the case for all of your quarterly clients, for example, maybe you've identified your quarterly cohort and some of them are still on QuickBooks Desktop, at this point you need to make a decision about which software you're actually going to support as part of your core tech stack. So what I'm suggesting here is that these softwares to deliver this service, you're going to make a decision at this point as to what become the specific service, the software that you're going to use. Now, what we've identified, let's go back to our monthly clients. We've identified that quite a large majority of our clients we offer payroll to on a monthly basis. Maybe we do some virtual CFO work for some, accounts payable and accounts receivable, and our T4s for all of our Canadian friends, group certs in Australia, and for those of you in the US, of course, W2s. Again, so these services might be something that you actually offer quarterly clients and annual clients as well. But what I'm trying to suggest here is that we have a set of annual or add-on services that we can added on to the core service offering. And in your sales process, once you've got a fixed fee for these add-on services, it simply becomes a yes/no answer to whether your clients want those services or not. Ultimately, what I'm trying to suggest here is we want to start seeing these patterns of services and helping you identify these things is going to help you easily identify what each of these cohorts value. Okay, so now that we've identified, did I go the right way? Yep. Now that we've identified sort of the cohorts, let's go going back to the original business model components. We discussed the notion of aligning all of your clients to a monthly value delivery. So the question you'll now need to ask yourself is, what additional value can I easily deliver to my clients that are not on a monthly service delivery, so my quarterly or annual clients? That's going to help them move to paying us on a monthly basis. So in other words, what services can I add to their core offering that provides the incentive to pay on a monthly basis? It could be as simple as a monthly report, or you could decide that in order to need some water. In order to facilitate an even better delivery of the annual services you currently provide, you're going to take control of their bookkeeping. So you're going to take bookkeeping out of the add-on services, or maybe it's payroll, and say everyone is now going to do that because I need to be able to make sure that when I'm doing my annual accounts, I'm in charge of the data. I'm in charge of the financials and what exactly is going on. So basically, this approach allows you to add some level of additional value and deliver it on a monthly basis at the same time as you ask for payment. Now, there is an alternative approach to this, and it's very simply, if you want to stick to your annual clients paying an annual fee, consider thinking about splitting the annual fee down just to a monthly fee and talking to the benefits of freeing up cash flow for your clients, of course, while still delivering the services on an annual basis. So for example, instead of one large bill when you do the work for annual accounts and tax return, we'll split the fee down to a monthly bill that will help your clients actually manage that cash flow. Alrighty, so let's use our cohorts to calculate a baseline price. So I'm going to use one example. Again, we're going to look at the annual compliance package. And now that we've identified the cohorts and identified the services that make up that core package, it's time to determine what it takes to actually deliver the service. So start listing out all of the deliverables and the key tasks that help you reach those deliverables. So in this case, we've got our annual compliance package, which requires, of course, a bit of admin time, depending where you are. Some of the lodgements here: preparation of financials, review and audit of financials, preparation of tax return and lodgement, accounting support, the filing fee, and then the software we use to deliver this service. So in this instance, we can still see that time is critical to pricing out your services, and it's made up of some pretty critical factors. So notably, who is performing the specific duty and what is their current charge-out rate? Now, you're probably wondering, how do we decide what a charge-out rate is, what the charge-out rate should be? It's really impacted by a lot of external factors, such as where is you're located, and therefore, how are you going to price that compared to your competitors? And it's also based on some internal factors, such as the level of expertise that each role provides in delivering the service, and what you would consider to be a fair value price in terms of a baseline. It also determines on what you want to be your baseline. What is the lowest price that that you would what is the fee that you would walk away from? What is the fee that you're not going to drop under? The other determining factor that time plays in pricing for fixed fees, of course, is how long it will take. So that's a really important piece of it.
Nice. And so, Tom, this chart is really helpful in terms of breaking out, okay, what are my costs for a particular service package? But if I'm in an advisor's shoes, I might look at this and think, you know what? I don't know exactly how much time is being spent on admin, or how much time is spent on preparation of financials. I might not have hard numbers, or I might not have any numbers. So how do I move forward if I don't know how this splits out?
Yeah, fair enough. And that's going to be the case for a lot of people, I can imagine. The thing about this is you don't actually need perfect data to start. It's actually going to come down a lot to gut feel at first if you don't have this information. So it'll have to be your best guess at first as to how long each of these certain items should take. And I should clarify, just so we know what we're looking at here. 0.1 time per hour, so that's 6 minutes, as we can see. Just wanted to make sure that was nice and clear. So what we want to do, just to come back to your question, Yusuf, is each client is going to be different. Let's not worry too much about that right now. We're going to talk about that in a moment, but instead let's just focus on the averages. And what's really important going forward is that you do start to track this time and regularly review it. There's some fantastic tools out there. I'm pretty sure most people would have heard of T-Sheets as a great place to track your time. But what you'll also need to do is regularly review it. And if you have staff required to work on this service, the important thing is there's a real cultural perspective you need to apply in your practice. Make sure that they know it is perfectly okay to log time over and above what you've allocated. So if you say, okay, the preparation of financials on average is 4 hours, and one of your staff members is taking 6 to 7 hours every single time, that's perfectly fine. We don't want them to feel like they're going to be reprimanded for logging that time over and above, because that leads to the classic issue of sandbagging, taking your time and allocating it to other staff to make it look like you're under your allocation. We really want to avoid that. So of course, you will want to make sure that they are logging the reasons why the time went over, so that you can understand what needs to change the next time you review your pricing. So is it a training issue, or is it that it simply, on average, takes this long to perform our services? Guy has a really good saying about starting fixed fee pricing, and it's very simply, no matter where you start, you're probably going to be wrong.
So the biggest piece of advice is start,
yep,
write some numbers down, and then track it. And
yep,
see what's real. Exactly.
That's
Great
right.
advice.
All right. So as we said, there's going to be so many different variables, and clients are different, and all that stuff. As you're going through the above process of breaking down your core packages, listing out the deliverables and the services it takes to do that, every single client is different. But what we want to focus on is the commonalities between each client, and not be too worried about losing a little bit on one client. What we need to worry about is losing on hundreds of clients, on every single client. So being mindful of, okay, how long should this take? The average client, factoring in, some of those bigger variables for sure. And something that's going to help us do that, of course, is the law of averages. So it goes without saying, we really want to make sure you counter those overages and underages by regularly reviewing your service bundles, making sure you actually got those right. The biggest piece is developing a standard tech stack and workflow. So going back to that sort of breakdown, making a key decision about what software you're going to support in order to deliver that service, and sticking with it. Really important, because if a client's coming on board, like for example, if let's look at bookkeeping. At this point, there might be many different ways you're performing bookkeeping. You might be doing, the shoebox method. Someone comes in and drops the receipts off, and you go in and scan them, or you manually code them in, or perhaps you go in and pick them up, or perhaps you go to their office and work out of their office one day a week. What we want to do is we want to start avoiding those different scenarios and coming up with a standard way of working. So if someone's coming on for bookkeeping, maybe the rule of thumb is that everyone has to use HubDoc, because HubDoc makes bookkeeping scalable. You can't scale picking up receipts from your client or sitting there and scanning them in yourself. That is literally impossible, because it is all dependent on time. And you can only be in one place at a time. When you start to leverage a tool like HubDoc, what you get is a process which is automated, and it allows you to start repeating that for every single client. Now, of course, what's also important in terms of countering those, the money you might lose on some clients, is to constantly optimize those systems. And as your team gains experience while charging the same fee. So, we might come to a conclusion that our bookkeeping service is $300. That's how much we want to charge. That fee doesn't stay the same if you get faster at it. So let's say you determine that there was some feature in HubDoc that you didn't even know existed, and it's now saving you half an hour per client, that doesn't mean you should drop your fee by half an hour. It should mean that you should retain your fee and your margin goes up. So what I'm really saying here is that you should be looking at ways of improving your ability to deliver the service. So get certified in the different softwares, take a webinar, do some training, do whatever it takes, and make sure that your staff are doing that as well. Now, what's also important is that we remove the outliers when you're pricing out your services. But of course, there's going to be some clients whose needs and the way you need to deliver the service for them is completely different to everyone else. Remember, we talked about that 90% being how you determine your cohort. But when you do remove the outliers, ensure you are charging appropriately for them as well. There's no reason why you can't fix their fee, but it's certainly going to be a lot higher than the standard baseline service that you offer. And what should happen is, or what you really need to remember is that profits will increase per service in the long run. Keep that in mind with this approach.
Before we jump, so I think you mentioned it, but it's worth tying that back. So the profits will increase per service in the long run. Why is that?
Yeah, so I mean, what we're going to see is, there's certain softwares that are shared, and as you add on more clients, the cost per client goes down. So, like for example, Practice Ignition, we charge we're in Canada right now, so I'm going to use Canadian pricing, $79 for up to 100 active clients. Right. Once you get up to that 99th, 100th client, it's 79 cents per month. Right. So we can see that the cost comes down. But also what we see is, apps like HubDoc and QuickBooks, as a pro advisor, the more clients you bring on, the cost comes down. Right. So we can start to see how that margin starts to decrease.
So not only like the benefit of billing through leveraging apps at scale, but also like, what about kind of developing the tech stack and optimizing your systems? Like, is that where some of the profitability increases?
Yeah, absolutely. So, once you learn how to, do something really efficiently and you get better at it, the time cost comes down. We're going to see this in just a moment, actually. Let's have a look at that. Or before we do, we've actually got a few more things to talk about first. But yeah, let's hold that thought, and we'll come back to that.
Perfect.
Now let's go back to that annual compliance package and have a look at how this all comes together. So we've got the same thing, the same basic table that we've put in before. We've added a few additional columns here. So we've got the cost per annum. So our admin staff member does the admin work. That should go without saying. Their rate's $80 an hour. Cost per annum's 8 hours a month. So what we then see is we want to start to split this down to a monthly fee. So we need to break down that amount. So we are going to arrive at this amount here, $259.46. So that's a combination of your fixed fees. So we can see maybe it's the QBO subscription that we've included in this compliance package, is going to be $50 a month. We also have our filing fee that's been divided by 12, and then of course all of our time cost up here. Now, we've arrived at this price. That's great. It does include margin in your time cost, but really there's additional margin right here. What we want to do is we don't necessarily want to land off, finish on this price. $259.46 per month is a pretty ugly number by any means. Yeah. So we want to make sure that the price is actually marketable. So nice clean number, $275 in this particular example. So that's really what we want to get to. So of course, when you do sort of decide what your marketable price is, you do want to factor in an appropriate additional margin, but you also want to consider your closest competitors and make sure that you're not overpricing your services as well. Okay, so there's probably, I can't see the questions right now because I'm deep into the slides, but I'm sure there's some questions around, the variables that come up in services like bookkeeping and payroll. And they're great examples of services that have a lot of variables. And so, for example, payroll pricing is typically determined by the number of employees, and bookkeeping pricing is determined by number of transactions for reconciliation, number of invoices in accounts receivable, accounts payable, etc. So what we suggest in this case is to consider a tiered approach to packaging these types of services. So a great example is payroll. So we might say our base or core package is monthly payroll for up to 10 employees per month. Our bookkeeping might be reconciling up to 150 transactions per month. Now, these numbers I've just thrown out there. How you arrive at these numbers is determined by the types of clients you service. So again, it's looking at your cohorts, and let's start really dissecting them and what's actually happening here. What's the average size of the businesses that you deal with? That's going to help you determine what your base package will be. So if the average size of your monthly clients is 10 employees, then that's the price that's the number of employees we should package in and price up. If they're, if you're a specialist in e-commerce, for example, your number of transactions per month is going to be significantly higher that you need to deal with. E-commerce companies are doing thousands of transactions per month. So that in your baseline package, it might be, reconciling transactions up to 500 transactions per month. Whatever that number is really based on the clients you serve. And we don't have time to get into this, but that's where niching really comes into play. So the important thing to remember, of course, is once you've determined the tier ceiling, so up to 10 employees per month, for example, ensure you also price out add-on services for overages on that employee count. So for every additional 5 employees, it's $30, for example. And I actually want to give you an example. So these are one of my favorite clients in Australia, not playing favorites, but I just said that. Sea Change Accountants. They're in a few different locations in some of the regional towns in New South Wales. Sea Change. So this is actually off their website. We've got their base bookkeeping package, and if we look at their service, it's got all the basic things you would do. And note that additional charges where bank entries exceed 150 per month. So we can see that there. Their second package, which includes a combination of bookkeeping and payroll, we can see that for monthly payroll for processing up to 10 employees, so what they're saying here is that they're going to pay their employees once a month. If you want that to happen fortnightly, or for those of you in North America, I'm not unsure, or what am I trying to say here? Not sure what fortnightly is. It's every 2 weeks. Yeah. So processing, to do that is an additional $40 per month. Or if it's weekly, then we add $60 per month. As we can see, they've focused their cohorts on the typical size of business that they're working with, and they've made sure that, of course, there's going to be businesses that are larger, and they're factoring in that pricing. All right. Cool, so that's that. So let's actually, this is going back to what we were just talking about before. This is that whole idea of looking at your costs and margin to scale up your service packages.
Awesome.
So here is an example. This is that 275, the annual compliance package. And here's, a 5-month period at which we're going to be reviewing how much it costs for us to deliver the service and what's actually happening in the margin as we improve our systems and processes. So we can see the product cost is at this point staying the same. And what we're now seeing is that for the first 3 months, the time cost has stayed the same. Maybe after 3 months, you've decided, okay, I'm going to sit down and take a look at my pricing. And what we've established is that a certain process in this package is actually taking a little bit less than what you originally considered. So now we can see that the time cost has come down, and it's only come down by $15. So just keep that in mind. Now, in this example, we've got 100 clients. We've decided that in order for us to grow, we want to hit a growth rate of 5% per month in terms of adding new clients to this service. So as we can see, we're adding on those clients. Our prices remain the same. This is the amount of revenue that we're now receiving based on this growth rate, and our total cost is, of course, moving up with it. But that simple change, that simple price or time cost decrease, because we've streamlined our service, has resulted in the margin going from 5.6% to 11.2% per client. And so very quickly we can start to see, as we scale, our costs can come down and our profit margins can dramatically increase very, very quickly.
That's awesome. And that really does tie back into we were talking about how do we increase margin by lowering our costs.
Yeah.
And so as we look at kind of optimizing our workflow as one of the ways that we can increase margin, what are potential other ways?
Yeah, so just like we were saying before, there's many examples of software companies, and HubDoc being one, where they have a program, Pro Advisor program for Intuit, or offer cheaper subscriptions as you add on more clients. So factoring that into your product cost when you do your review, you'll start to see that your costs will come down per client, and therefore your margin will go up as well.
Right, and in this context, a $15 drop in cost actually doubled the margin.
Yeah, because we're scaling up. Yeah, and this is the key to scaling.
And so, I know we're going to talk about margins later on, and potentially how high they could get.
Yeah.
But do we know what like a typical bookkeeping industry margin would be? Like if I start out in the 5 to 10% range, like we're looking at here, is that a good margin? I
think it depends on a lot of variables. So it's hard to say that there's a standard. If we defer to the expert in the pricing field, Ron Baker, he sort of advocates for the idea of having contingency margins in there, like change of scope margins and those types of things. So those are all really good ideas that we can implement still in a fixed pricing model. But it's hard for me to say that 5% is the margin that you should be going for, because it depends on the service itself, who's performing the service, and who your direct competitors are in your region, how much they're charging, because you don't want to, again, overprice yourself and price yourself out of the market.
Right. And it also depends on your clients. If you have clients that earn a lot of revenue, they might be less price sensitive.
Absolutely. Yeah. So I think that's something that's going to have to be a bit of a journey that you will need to establish yourself and really understand those external and internal factors that will play into the margin that you're comfortable with.
Perfect.
Awesome. Alrighty, so reviewing costs and margin as you grow. So again, I think we've said this a million times already, but I'm going to say it one more time, and probably going to say it again at some point. Make sure you're focusing on efficiency. So as you add more clients, your costs will decrease, and as you improve your processes, your time costs will come down. Review your costs regularly. The big one is to change prices annually. So increase your fees. Everyone wants to. Not many people do, but you really should. Everyone, I'm an employee of Practice Ignition. If guys listening, I'd expect a pay rise every 6 months or so, whatever the case might be. Why shouldn't a small business owner expect a pay rise as well? So basically what we want you to do is start thinking about doing that annually. Now, it's important to note you don't want to just do a fee increase for the sake of doing a fee increase. It's important, it's in fact critical that you add additional value when you do that increase. So again, thinking about ways to very simply deliver additional value, whether it's an additional report, maybe you start, maybe you implement something like Spotlight or Fathom reporting that can easily and very quickly produce a KPI report that you can now deliver as part of that service. Or perhaps you've improved your system of support, and maybe you've onboarded a support desk tool that allows you to quickly answer those quick, simple support questions, and so therefore adding additional value such as unlimited support questions per month is an easy way to increase your fees.
Awesome. So yeah, before we jump into the role of value pricing, one of the questions that's come up a lot is, okay, so we've talked a lot about fixed fee pricing.
Yeah.
There's some, I think people really want to understand what's the difference between fixed fee pricing and value pricing.
Sure. There's actually not a lot of difference, to be honest. When you value price, you still want to factor in, efficiencies, time cost, all of those things, and all those additional margin type variables that you want to enter in. One of the biggest probably differences is the 3-option value pricing, so presenting 3 options up front. And what I see a lot in terms of when people implement value pricing is that instead of changing the core package and add-ons, they're changing the type of service that's being delivered. So let's think about bookkeeping, for example. In a fixed pricing model, we're saying if you come on board as a bookkeeping client, you have to use QuickBooks Online, and we have to use HubDoc, and it's the only way we're going to work with you, because we need to focus on that efficiency. In value pricing, and I don't know if this is necessarily what the likes of Ron Baker want to happen, but what we tend to see is you might have a bronze, silver, and gold package around bookkeeping, and it says the baseline package is transactions, the second package is reconciling transactions plus HubDoc, and then the third package is we'll come to your office and we'll code the transactions or we'll scan them in. Now, the problem with that is it's not very scalable, because you now have 3 different processes for basically the same service. So that's where we're starting to see the difference between what we're talking about fixed fee pricing and value pricing.
And is one of the other differences kind of transparency levels? So fixed fee is kind of like the example that you showed with Seed Change.
Mm-hmm.
Yep. Where they have the 3 packages up on their website. Everyone can see, okay, this is what I get, this is the price.
Yeah.
But on value pricing, it's kind of more like opaque pricing.
Yeah.
So I have to talk to a salesperson or the advisor to be able to get a price, and they kind of assess my needs and then price on that basis.
Yeah, and I mean that's still going to happen in a fixed fee billing scenario as well, because of course, as we saw with the Seed Change example, we have a base service of 10 employees per month, and we need to determine if they have more than 10 employees or not. So there's still that element of having
understanding the costs.
Yeah.
But perhaps there's more variability in the value pricing.
That's right, because the emphasis in value pricing is more on the value perception in the client's mind. And that can vary from client to client, despite the fact that the service delivery is essentially the same. Yeah,
right.
So something to consider there. What I would suggest, and this is an important point, value pricing is 100% a valid model. And I think the biggest difference is scalability. Fixed fees afford scalability. Value pricing, it's certainly possible to still scale on a value pricing model, but ultimately it comes back to that same problem of if you have multiple processes for the same service, eventually you're going to run out of time. And the problem with that, of course, is that you then need to either hire more staff, or you need to figure out a way to not impact your other clients. And that's what we're really trying to avoid.
Got it. That makes sense.
Yeah, awesome. However, there is a role of value pricing in our model that we're suggesting here. So we're actually looking at a hybrid model. That's what we sort of suggest here. And this is Guy Pearson, again, our CEO of Practice Ignition, founder of Interactive Accounting. He has what we call the HUG rule. And Heather Smith, fantastic, just full of knowledge. You can follow her on Twitter, Heather Smith AU. Her tweets are a goldmine. This actually was very, very timely. This was just the other day. Businesses begrudgingly pay for compliance work because they don't necessarily recognize the benefits of accurate numbers. The HUG rule says, have you ever been hugged for a client for completing a tax return or completing compliance work? Chances are probably pretty slim on that. As we see, clients typically don't see the value in compliance work. It's just something that they have to do. So what we're suggesting is that anything that's sort of compliance-based and repeatable is your opportunity to build trust. Get them in at a seemingly low price point, particularly when you compare it against their last bookkeeper who charged them, or accountant who charged them by the hour, and over-deliver. And the over-delivery will be facilitated by the apps that you put in your tech stack. So HubDoc, the QuickBooks Online, Practice Ignition, to get them on board and automate their payments. That's going to be an amazing experience that compared to like having to drop a shoebox of receipts every single month or not at all. And so what happens when you do this is your opportunity for high value project work is tremendous. Because you're delivering real-time financials, and perhaps you go above and beyond, like I said, maybe you implement a Spotlight reporting or a Fathom, and one month you get on the phone and say, hey, Doug, I'm Doug, sure. Hey, Doug, you know what? I've been running your financials through our KPI system here, and I've noticed X, Y, and Z. I thought you'd be interested in seeing this information because I think it's going to help you make some decisions about how you're pricing out your services or the inventory that you're holding, for example. And all of a sudden, that opens up an easy conversation for you to have with your client, and therefore that opportunity to have a project related to what you've just shared with them. So the HUG rule goes, we want to start implementing that idea of value pricing on your projects that arise from that, that opportunity that you get for delivering amazing experiences at the compliance level. Because at that point, project work is by its nature different from client to client, and it's really hard to build a process around that. So what you can do is really focus on the value proposition. What is the return on investment that this client's going to receive when I perform this project for them? So now we can start to see how value pricing has a role in a fixed fee accounting practice. So of course, when you do that, the general rule of thumb is like, if I'm going to get a hug from this client for having a positive impact on their business, then I should value price that service. If it's going to be something that they begrudgingly want to do, then I should be fixed feeing that service.
Got it.
Awesome. Okay, so now that we've established how we go about doing our fixed fees, the next step is how we're going to have this value conversation. In what we're going to talk through right now, actually, I just realized I missed a point. I just want to go back for 1 second on this. Got a bit of a bonus tip for you. Let's say that you bring a project on from a client, and you can see that project can now become repeatable. What you can do is have your client pay for it. Essentially, it's research and development. You're doing R&D on a service. What you can now do is take that, document that process of performing that project, and now all of a sudden you have a process for delivering that project and a price that you can now service other clients with. And you've only ever had to do that once. You've built out your process, and in fact, you might even have some intellectual property that you can then repeat. And all of a sudden, you now have this amazing service that doesn't take a lot of energy or a lot of time to deliver on a repeatable basis. So keep that in mind as well. All right, so let's get back to having the value conversation. So in the context of what we're talking about here, it's more about shifting your existing clients. With new clients, it's really, really easy. They've never experienced any work with you, so their expectations haven't been set just yet. So what we want to do for your existing clients is announce in advance that you're going to be making this change. So, maybe an email 90 days in advance explaining why you're changing this pricing model. And so some of the reasons why, or some examples of the reasons why, would be, it allows your firm and their business to go to the cloud and move towards real-time financials, or a very common business conversation to have. It maintains a profitable and cash flow positive relationship between you and your client, so that you can continue to be their advisor well into the future. And of course, a really compelling reason for fixed fee billing is that there's never going to be surprise bills. So, we get to a point at the end of the year, maybe we're doing annual accounts, and then they get that massive bill. They always come back with, oh, I didn't know it was going to be this much. That's a problem. We want to avoid that by splitting it into a nice even chunk, and of course, that's going to have a great impact on their cash flow. So something that we're going to deliver, after the fact, after this webinar today, we've actually written up a sample email template that you can potentially use with your existing clients. So keep an eye out on your inbox for that. We'll be happy to share that with you. So while you're in the process of actually determining your prices, it's important that this becomes a conversation with your clients. So sharing your plans, especially with your ideal clients, the ones are going to be really receptive to it, and work together to figure out which ones are going to make sense to them. So, part of moving to fixed fees is being transparent and openly sharing your pricing. That's really important, because we talked about transparency already. These prices are going to be fairly transparent to any client. please note that you will be reducing fees for some clients. Typically you might go back and look at their invoicing, and on an hourly basis, you've been able to charge a significant amount. But once you've moved to that fixed fee, you know that that price is going to drop, but that's okay. Remember, don't sweat the small stuff, because you really want to focus on the efficiency and take the onus of time away from billing and onto that efficiency. And of course, ask lots of questions. What is it that they need? What is it that they want? And that's going to help you determine what services you're including in your fixed fee packages. Now, communicating after you've transitioned to fixed fee pricing. Now, this doesn't just stop once it happens, but the first thing you'll need to do is make sure that you get your fees approved in writing with an engagement letter. This is critical because this is how you dictate the scope of work. In an hourly billing model, the scope of work didn't really matter because it just mattered on the number of hours you did the work in. So it didn't really matter to say that, we're going to do X, Y, and Z. If a client calls you up and says, yeah, I want you to do my AP for the month or whatever, then you just added more hours on. But in fixed pricing, that can't really happen. You need to clearly define the scope of work, explain exactly what the deliverables are, what the limitations are, and what should happen should that scope of work change. And the best place to do that, of course, is on your engagement letter. Now, as I said, this process of communication is going to continue for the rest of time with your clients. So setting regular reviews, whether that's quarterly, I wouldn't do anything less than that or anything more than that in terms of, try and avoid just an annual review. But if you're not doing any kind of reviews, then maybe that's a great place to start. But yeah, at least quarterly, I would say. And this is your opportunity to upsell. It's your opportunity to have that conversation, demonstrate the value of the services that you've offered or that you've delivered in the last 3 months, and show how you can deliver more value by presenting a couple of extra services that you could potentially add on. And it's also your opportunity to minimize scope creep. So scope creep is very simply when your clients ask, but more importantly, receive more than what they're actually paying for. And that's a big issue in fixed fee pricing. So a great example is that payroll service, for up to 10 employees. Maybe in between when they sign their agreement and the first review, they added on 3 or 4 more employees. Now it's your prerogative to back charge for the that extra work that you did, but we don't really want to get into that whole nickel and diming approach with your clients and changing every single time an employee changes. Instead, what you might decide is that at the review period, you're going to say, all right, so for the last 3 months, we agreed to 10 employees, but we've actually been running payroll for 15. I'm not going to charge you any more for the months that have already passed, but going forward, I'm going to move you up into the next bracket, which is up to 20 employees. That way, it's going to allow you some room to move. So it looks like, based on your financials, that you're set for growth, because of course we're giving them real-time financials, we're giving them the ability to look forward, so we know that, and it's going to allow us to continue to service you at the same level. The important thing to do as well is re-engage annually with an engagement letter, and it goes back to that idea of increasing your fees annually. This by getting them on contract again for another 12 months, or at that time, that's your opportunity to actually do that fee increase. Alrighty. So let's dive into the notion of scaling up and becoming more profitable. When you're on a fixed fee billing model, the #1 metric is MRR, or monthly recurring revenue. I have a tweet somewhere I mentioned Chris Hooper before. He mentioned something about, if MRR is growing, everything else is semantics. He just goes into his ledger to make sure he's not broke. Pretty telling or compelling reason why monthly recurring revenue is super important.
And when we're talking about monthly recurring revenue, that's the monthly fixed fee cost that my client is paying.
That's right. So it's your revenue that you're earning on a monthly basis.
Got it.
And the culmination of that revenue into one key metric. And Practice Ignition, of course, I'm going to mention this.
Yeah.
We have a dashboard that will actually show you your MRR automatically based on what's been agreed to in your contracts. So pretty cool. But yeah, so really important that we focus on MRR. Now, I'm going to take a step back and let's talk about the traditional growth model for an accounting or bookkeeping practice. In a traditional model, there's actually no incentive to grow because your costs grow with you. There's no incentive to become more efficient because it's all time-based. You know, like, why do we want to be more efficient? We're going to lose money that way. And profit margins are typically static. So let's actually have a look at what that looks like. So here's as a traditional sort of example, or maybe a generic example of a growth model in a traditional time cost billing accounting firm. Growth is experienced through referrals. You know, tax season, of course, you're going to achieve a big revenue bump. And of course, the other way that most firms grow is through existing clients opening up new businesses, and therefore you're going to service those entities. You can see that the costs remain fairly static, and the cost margin, the profit margin, also remains static. Now, losses happen because of poor communication, or the clients just simply do not come back. I mentioned this point the other day at a conference. I've gone through 3 different tax agents in the last 3 years, and the first 2 didn't come back to me. They had no response. There was no communication, no wondering where my tax return was for this year. The latest, the accountant that we use now, they were proactive. They sent out an email getting everyone ready well in advance of the deadline. It was amazing, and that's what's really missing. That's what was typically the case in a traditional accounting model, was we were too busy to deal with that sort of marketing and retention. So what the MRR growth model does is it gives you the incentive to grow. You'll probably notice that as you're onboarding new cloud apps, your software subscriptions have gone through the roof. I bet you many of you out there have said that I am paying more in software subscriptions than I ever have in my life. And that is absolutely true. But as you get more efficient and as you add more clients and scale up, because that's what we're trying to do with a fixed fee pricing model, your costs will eventually plateau and your margin will grow. So there is a massive incentive in this case to become more efficient. Rather than just adding more hours, we're looking at ways to get better at delivering our services, either through onboarding software like HubDoc, or looking at ways to get better at using HubDoc by getting certified and watching webinars and improving the way we work. So here's what the MRR growth model actually looks like. So as we can see, the costs grow pretty quickly, but as we systematize and develop our core stack and our core processes on all of our services, they will plateau. As we grow our client base and add on more services, and of course go through the process of reviewing your pricing, annually increasing your fees, the margin between your costs and your price grows significantly, and 40% is definitely something that can happen. That is the case for interactive accounting. They have a 43% margin on their services by the time they're scaled up. Now, what we're also seeing is the project work gets treated separately. These are your value-priced project work, and they become pure profit. And what we really want to think about in this type of growth model is that they should fund your growth activities. They are going to help you fill your funnel. They're going to be the things that you can develop and new services. They're also going to be the way that you can pay for those marketing sort of services, or the marketing that you do to attract new clients. So this is the sort of the mental shift that we need to take when we adopt fixed fees, is thinking about our recurring services being sort of core to growing our margin, and our projects, which can easily be value priced, to fund those growth activities. So I think I said before I wasn't going to say it again, but I'm just going to say it again. As you streamline, you focus on efficiency and driving the cost of doing everything, the everyday services down, or the everyday activities down. And what you'll notice is, of course, that you're constantly boosting your profits over time. So let's try and forget about that idea of, we're paying too much in these costs up front, because if you really adopt this model and execute on it well, this is what's going to happen.
Okay, so we're going to go for our last poll, and then we're going to do kind of the question and answer period. So thanks to everyone for sticking with us. Okay, so we're live. What accounting software are you currently using? QuickBooks Online, QuickBooks Desktop, Sage, Xero, Other? Love seeing the engagement. I know we've been going, 75 minutes, maybe 80 minutes now. And I know I've personally really been enjoying the content. I hope you have too. So at 73%, 75%. Let's see if we can get above 80%. I'll give it 5 more seconds. 5, 4, 3, 2, 1. And there we are, 80%. Wonderful. And yeah, let's share the results.
Look at all those online users. That's fantastic.
That's amazing. we have a lot of people here today. We're in the hundreds, which is kind of amazing.
Outstanding results.
Outstanding results. That was Matt from QuickBooks.
So what I'm seeing here is that there's many people out there that are actually supporting multiple software, because obviously we've gone above 100%.
That's a good thing to point out.
Yeah. So I think hopefully one of the takeaways today is that it does kind of make sense to really stick with one and support it 100%.
And standardize, and that's how you get the benefits of optimization.
Yeah, absolutely. All right. So where are we? Oh, here we go. So to finish up today, obviously we're going to have Q&A. But there's 3 takeaways that we really want you to remember. Big fan of the rule of 3. The first is remembering to align the 3 components of the cloud business model, and as a reminder, they're value, costs, and invoicing and payments, by focusing on a monthly delivery. Remember to not sweat the small stuff. Yes, you're going to lose on some, you're going to win on others, but most importantly, just get started. And then, of course, it's super important that you're constantly reviewing your prices, your processes, and your tech stack. And ultimately, remember that we are here to help. So don't be afraid to ask. I'm going to hand over to Yusuf. Before we get into the Q&A, we've got a couple of offers for you.
Awesome. So for those unfamiliar with HubDoc, I'll just do a quick 10-second spiel. So 2 questions you want to ask yourself if you're considering using HubDoc. One is, do you have the challenge of getting documents from your clients? I struggle to ever meet a bookkeeper or an accountant who doesn't have that challenge. And then the second question is, do you have to do data entry against those documents? So what HubDoc does is it goes out and automatically fetches bank statements, receipts, invoices. So whether it's your Wells Fargo bank statement, your AT&T receipt, we'll go out and get it, extract the key data instantaneously, and then push it across into your accounting system, so like QuickBooks Online. And the really awesome thing is we love working with accountants and bookkeepers, and that's why we do webinars and content like this. And so if you want a free HubDoc account to test it out with your practice, and I can tell you I use it personally, it's pretty awesome, just go to hubdoc.com and hit the try it for free button and check off the box to say you're an accountant or bookkeeper, and you can try it out today. So head on over. And thanks so much for being here.
I actually use HubDoc too for my personal tax return. It's been pretty awesome, and Joe over at Avalon Accounting is pretty stoked that I do. So there you go. So in terms of PI, same thing. I'll do a quick spiel. Basically, in this fixed fee billing model, we talked about making sure we have an engagement letter in place. That's what Practice Ignition is designed to do. Make that as seamless as possible. Let's not use Word documents to do that. Instead, let's take it online and give your clients the best possible experience. We also integrate directly with QuickBooks Online in terms of invoice automation. We'll also go out and collect your payments for you automatically. So eliminating a lot of that work so that you can focus on delivering those monthly services in the best possible way. So we've got a couple of offers for you. We have a monthly fee. We also have an annual plan that if you sign up for that, the first $30,000 of processed payments is going to be on us. And we also have an optional training and implementation program that you certainly don't have to do the training program. You can certainly set up your own account. But if you are interested in having one of our customer success managers guide you through the experience and set up your account, we'll take 50% off that fee today. Or actually, not just today, when we email you. One of the things that you can do to get started straight away, you can book a one-on-one demo so you can learn more about Practice Ignition on the link that you can see there, calendly.com/PI-launch, and you'll get set up with one of our territory managers. Takes about 20 to 30 minutes to go through a demo. So awesome. So I think that's it. Let's dive into the Q&A.
Awesome. And just one last thing, if anyone's at Scaling New Heights next week, definitely come by the Practice Ignition, QuickBooks, and HubDoc booths, because we'll be there with bells on.
Well, you can wear the bells.
Yeah. So we got a lot of really great questions. So I think one of the questions is around scope creep.
Mm-hmm.
Okay, so I started with this client. They originally had 100 transactions for the month, and now they're doing 150 transactions.
Yeah.
How do I handle that?
Yeah, absolutely. So this is actually one of my favorite topics. This is I've done a whole webinar dedicated to just this topic, and so I could be here for hours. But to avoid everyone being bored out of their mind, let's talk the cliff notes. So there's two things to consider here. First of all, if it's only a little bit over, is that too much of a big deal? Like straight away, you can sustain that for a little bit. Eventually, you do want to address that with your client, and that's where those quarterly reviews come in. Again, I said it earlier. It's your prerogative to decide whether you want to charge for that additional work that you did. But the chances are, if it's only 50 transactions over, the bank rules in QBO have probably taken care of it, to be perfectly honest. But having said that, an agreement is an agreement, and you want to address it. So I mentioned in the conversation that you could have is very simply, okay, going forward, we've been servicing you at a higher level than what we agreed to. So we're going to increase the scope by moving you up into the next tier, and for the we'll review this in 3 months' time. But this is the fee you're going to pay, and it's going to allow you to address that. And as I said, with real-time financials and looking at that data and modeling it to look forward, you should be able to anticipate that pretty easily. So my projections are that you're going to do X amount in sales. In the next 6 months, I anticipate you're going to be doing X amount of transactions. So we're going to increase the scope at this point. The other point is to have an engagement letter. And clearly defining that. It astonishes me how many people work on a verbal agreement, and that is troublesome. And I can understand that when you're on an hourly billing model, because who really cares? But in a fixed fee model, that is critical.
Got it. And so one question, I think there's been a few questions about benchmarking.
Mm-hmm.
And so on a fully cloud optimized practice, how many clients can one full-time bookkeeper handle as the business grows?
Yeah, that's a great question, and I think again, there's a lot of variables that play into that, and it comes down to crunching the numbers. And this is a very timely point for me to say that Guy created this spreadsheet that actually allows you to create your service packages. And when you do that, there's another tab that allows you to basically project your growth. So how many clients am I wanting to bring on board in the next few months? And it's going to show you those numbers, which will allow you to start sort of going for that capacity planning. Now, in terms of how you actually decide how many clients can one single person handle, there's too many variables for me to give a number out. Instead, it comes down to training. So, maybe developing a process for onboarding your employees. Those processes are really going to help you establish that number as well. Making sure that all of your clients go through QBO certification, all of your employees go through QBO certification, HubDoc, etc., or any of the apps that offer certification, so that they can get better at it. And eventually that capacity planning will become more apparent and more evident. So that's a really big thing. So if you're interested in receiving that spreadsheet, maybe, I don't know how best to do this. Maybe I think we'll just send it out to you guys. So yeah, we'll make sure that gets into your inbox.
So, you know, we've talked a lot about the benefits of the cloud and how that fits in with a fixed fee model. Is it possible to implement a fixed fee model with desktop solutions?
I mean, theoretically, yes, but reality is probably no. Like the desktop model is not scalable. I mean, you could use systems that allow you to remote access and do all that kind of stuff, but the reality is you're just not going to get the real-time data, which allows you to provide real-time financials, and that's the key to the scalability of a fixed fee pricing model. You know, and that's the reason why all of these apps integrate with each other, so that we can facilitate this value proposition of amazing delivery and amazing, like, developing an exceptional experience. And so, you know, keeping your clients on a desktop, GL is not really going to work in terms of developing a scalable process.
Got it. So one of the other questions here is, it kind of comes back to that idea of scope creep, just a bit of a different angle. So this person's mentioned that it's very difficult to assess in advance how much time a new client will require.
Yeah.
Because they always kind of underestimate how much work needs to be done. So for instance, there's a bank account they forgot to mention, or a loan or something.
Yeah.
There's, like, you know, there's kind of that scope that does creep in.
For sure.
How do you price in advance for a client? Like, how, maybe that's not the right question, but like, how would you approach that issue?
So I'm glad this came up, because there's a few different ways that people do it. You know, ultimately, if someone's coming from a previous bookkeeper or client, they're not coming to you with just 1 month's worth of work. They're probably coming to you with 6 months worth of work, and it's an absolute mess. So in those types of scenarios, that's actually one of the scenarios where hourly billing makes sense, to just get started and to get to know, you know, what's actually happening in the business, get them up to a point where you can start to see the patterns. So, you know, maybe it's for the first 3 months, you're going to quote an hourly rate until you get their books up to speed, and then eventually, you know, you get to see the volume of transactions they're running each month, like what their AP and AR looks like, and then at that point you can fix their fee, or determine what bucket or what package that they're going to go in. So that's one way of actually doing it.
And so is that, so what we talked about on the webinar today, in terms of benchmarking each of the different services and each of the different roles, and giving yourself time to figure out how everything kind of splits out, so that you can move from that hourly model, like leveraging the hourly model to figure out, okay, how much time is being allocated to different tasks and to different roles, and then backing that out into a fixed fee model.
Yeah, absolutely. So, yeah, if we don't have that data in place already, then yeah, that's an easy place to start. You know, divide, like, even if it's dividing the first 3 months by the number of hours you did, and then fixing the fee that way. You know, that's an easy transition. And then eventually, once you get the data in place, you can really fix those fees and determine the packages that you're going to start off with.
Got it. And so that kind of brings up the question of engagement letters and defining what is the scope of the work. Is there an engagement letter template you would recommend? Is that something that we can standardize in PI?
Yeah,
Practice Ignition?
So when we talk about an engagement letter, there's a few different components that make up an engagement letter. There's the services or the scope of work, so what exactly it is that you're doing for your clients. And then there's, of course, the legal terms and conditions. And there's also your terms and conditions, so how you go about performing those services, what you need from the client in order to complete that service. So, for example, if it's payroll, you need pay stubs by X day of the month, etc., etc. That's what we refer to as service terms. So for those terms and conditions, you know, the legal text, the generic stuff, you'll bring that in to Practice Ignition, for example. But when someone comes on board to PI and they do our training program or watch our webinars, there's a bit of a templated process by which you can scope out your services and clearly describe them to your clients. And it comes down to 4 components. It's the deliverables, the time frame, the software, and the limitations. And so if we look at those 4 components when we're writing out a service description, the deliverables should be outcome-based. So what is it that the client's receiving and what value will that result in for them? What is the outcome they expect to receive? Of course, the time frame is the frequency by which you're delivering that service. So if we're talking about a payroll service, we will be running the payroll on a weekly basis or a fortnightly basis or a monthly basis. We will be we'll be lodging your tax quarterly, et cetera, et cetera. Software, pretty bit of a no-brainer there. We will be using HubDoc, QBO, et cetera, and making sure that that's on your engagement letter. And then limitations is about exactly what we're talking about. Payroll for up to 10 employees. That's a limitation there, as well as anything that results in scope creep. So and how you actually address that scope creep. So the final piece of a good engagement letter would be what happens when the scope of work changes and how we're going to go about changing it with you.
Got it. And so, there's a number of questions here about kind of cleanup work in the context of hourly billing and value pricing. How would you do hourly billing on PI for a cleanup job and then move them over to fixed fee? Would it be 2 engagements? Like, what would be your recommendation?
Yeah, so I would say in Practice Ignition, I'm assuming this might be coming from someone who's trialed or is just getting started on PI. Hard to really demonstrate this without dumping in. But yeah, in that case, it's very easy to create a quick proposal with an estimate. And then you can actually still deploy the invoice in QBO on that estimate. So once you've finished that work, you just push a button and then off goes the invoice and off goes the payment collection. So starting with one proposal for that, that upfront work, and then once you've done that work, getting your client back in for the conversation. So actually having, whether they come in person or you do it online, and getting into that fixed fee pricing conversation to say, okay, these are the fees that we've, based on what we've done, we agreed to, and we're going to sign a new agreement for the next 12 months or whatever the case might be. So yeah, that would be the easiest way to do it in PI.
Cool. And so when shifting people across from an hourly model to a fixed fee model, kind of the approach typically is to kind of average out the hourly and kind of benchmark numbers, and then perhaps add a slight margin to just give yourself a kind of a buffer, right, in case you go a little bit over. Have you seen people successfully increase prices while also moving to a fixed fee model?
Yeah, absolutely. But I think I don't know if that's necessarily what we want to focus on. It goes back to that whole idea of building out cohorts and determining your process. That's the key to this whole thing. So it's about not sweating the small stuff. Sure, like it's a really nice outcome if you do actually increase your fees, and it can absolutely happen, because what you're saying is, if you're going to continue to do your bookkeeping with me as a client, we're going to ask you to, you are going to move to QuickBooks Online, HubDoc. We are going to deliver this on a monthly basis, et cetera, et cetera. So for those clients that are maybe only doing, they're sending in their receipts and doing all that stuff on a quarterly basis, that's probably going to result in a higher fee. But I don't want you to really focus on that. We want to focus on efficiency. I said it a million times, I'm going to say it one more time. Focus on efficiency. That's the key here.
Cool. And so we covered it so much on this webinar. One of the questions is, can you further detail the HUG rule and compliance work, and is there any relationship or correlation between HUGs and compliance?
There's actually a formula. So the HUG rule, so this is Guy's baby. I stole it from him for sure. Compliance work being anything that a business has to do, really, in order to be compliant with the tax agent, tax organization in the company that you're in, country that you're in. And so compliance work is something that people don't really want to do. They don't really want to pay for it, but they know they have to, so they're going to. So we're basically saying they're not going to hug you for this. They're just going to expect you to do it. And those are things that that are typically repeatable: tax returns, bookkeeping, et cetera, et cetera. So as the general rule of thumb, the hug rule is if you have to do it, if the client has to do it, you're not going to get a hug for it. But if you start to take that data and turn it into a conversation about how they can grow their business, because you're giving them real-time financials and you're starting to uncover some things that can help them identify ways they can grow or improve their cash flow, things like that. And then turning that into an opportunity to do a project for them. If you execute on that project well, I guarantee you're getting a hug for it, or at least a bottle of wine or something, as well as getting paid for the value that you've delivered. So I hope that helps clarify that rule. And I don't know what the metric is around how many hugs you should get per project.
So I think that was our last question.
Okay. Awesome.
Want to remind everyone that we'll be sending out a recording of this webinar, and thank you so much for being with us today. We'll also send a copy of all of the slides, and we'll be following up with an NPS survey. So that's just to get your feedback. Tell us what you liked. Tell us how we can be better. We'd love to hear from you. And thanks so much for joining us this evening, or morning, or afternoon, wherever you are.
Thank you, everyone. It's been great fun.
Thank you, Tom. It's been amazing.
Awesome.